Okay, welcome back to our next session here, which is on mutual fund expenses and share classes. So, as I was saying, mutual funds all have expenses, and we're going to talk about how those expenses are. And investors pay those expenses. Not necessarily do they write a check or anything, there's a fee that they're charged, but instead it reduces their return on investments. It's basically like income minus expenses equals profits. So, instead of like paying a separate charge or something, they just see the results in their basically in their net asset value of their fund. Now, mutual funds have come up with different share classes as different ways of structuring the sales charge to make it more suitable to a particular investor. Okay, now one of those fees, is in fact the one that's maybe a little hardest to understand, are called 12B1 fees. 12B1 fees specifically are there to cover the cost of marketing and distribution, right? Things like advertising, printing and mailing prospectuses, maybe things like trailing commissions to registered reps. Those might come out of 12B1 fees. Now, again, investors pay those fees. They don't see it as a charge, for example. They see it as it's a drag on their return on their investment. Right. Any change to 12B1 fees has to be approved, right, by shareholders. They have to vote on it. So it comes up to a shareholder vote. It also has to be approved by the board of directors of the fund and by the independent board of directors. So what independent means that they're not affiliated with the fund in the other way. Mutual funds have to have a certain number of people on the board of directors who are not affiliated with the fund. See, someone's like, say, a vice president of a division who's also on the board of directors, that would be affiliated. That would be right. That would be a affiliate board member, but they have to be non-affiliated or independent, right? That means they're not connected. They're basically, some of them have to be outsiders. So it also requires a majority vote from the outsiders who are on the board of directors. All right, what's the typical 12B1 fee? It's typically 1/2 of 1% per year, 0.5%. But FINRA rules do say that the maximum 12B1 fee is 0.75% or 3/4 of 1% per year. It's an asset-based charge, so it's based on the average net assets of the fund. Now, for a no-load fund, remember, no-load means there's no sales charge. Maximum 12B1 fee is 0.25% or 1/4 of a percent. As the slide says, it's also the same as 25 basis points. If you remember that a basis point, okay, a basis point is equal to 1/100th of 1%, or 0.01%. So 25 basis points is the same as 0.25%. All right, okay. Now there are for the test anyway. There are 3 share classes, right? Class A, Class B, and Class C shares. In the real world, there are more than these, but for right now, Class A, B, and C shares. Now, the classic kind, in fact, before they made any other type of share classes, there was just one class, but now they call them Class A shares. That has the front end sales charge or front end load. If you remember that the word load and sales charge mean the same thing. Sales charge equals load, right? They're just synonyms. They're the same word, mean the same thing. Okay, so with the Class A funds, they pay their sales charge going in, right? And this is the one that uses the NAV and the POP pricing structure, because remember the POP is the net asset value with the sales charge added on top of it, like wholesale and retail. So they pay their sales charges going in, taken off the top, one time off the top. So if someone invests $10,000 and there are $500 in sales charges, $500 comes off the top, $9,500 gets invested. Now, because they charge you right off the top, they get their money out of you right away. They don't have to make up for it as they go. So Class A shares have the lowest ongoing operating expenses, the lowest 12B1 fees, if they even have a 12B1 fee. Given enough time, it'll take several years, but given enough time, right, the lower operating costs will more than make up for the upfront fees. Takes a while, but it will. So Class A shares, now they're better for someone who has a large amount to invest, because they can get breakpoints. They can get reduced sales charges. It's like a volume discount. Also, they should have a long time horizon to take advantage of the fact that the lower operating costs ultimately, of course, make up for the upfront fees. Now, FINRA does have a rule. FINRA's maximum upfront sales charge is 8.5% of the public offering price. So if you ever get a price quote and you see that the difference between the NAV and the POP is more than 8.5%, you know that cannot legally be an open-end fund? Right? If it can't be an open-end fund, what could it be? Can you tell me? Okay. Right. It could be a closed-end fund, couldn't it? Yes. Oh, yes. Okay. So that's the Class A shares. Now, to make it more accommodating for other investors, they also have Class B shares. Class B is the back-end sales charge or back-end load. If it helps you remember, B for back-end. So instead of paying a sales charge upfront going in, instead they may be subject to a sliding scale sales charge on the way out when they redeem their shares. It's known as a contingent deferred sales charge or CDSC. It's deferred because you don't pay it going in, you pay it going out, right, when they redeem shares. It's contingent because the longer they hold their investments with that fund, the smaller the sales charge becomes, eventually going down to zero. Now, every fund is going to have its own CDSC, right? And the details are always in the prospectus, which also means if the test asks you the question, it's got to give you the information. But maybe something like if you sell within the first year, they'll charge you 5% on the way out. But if you sell in the second year, 4%, third year, 3%, and so on. And then maybe after 6, 7, 8 years, no sales charge at all. And when it comes down to zero, then the Class B shares, right, will eventually convert to Class A shares without ever paying a sales charge. And what's so great about Class A shares? Lower operating expenses. Now, since Class B shares, since they don't charge you anything up front, they don't buy at public offering price, they buy at net asset value, nothing's being taken off the top, but they do have higher operating costs, right? They do get it at, they do charge you more as they go. So Class B shares have higher operating costs over Class A shares. Now, Class B shares are better for at least medium-term investors. They plan on holding at least long enough to avoid paying sales charge, and for somebody with a smaller amount to invest, not enough where they can get breakpoint discounts. Class C is the level load, a level sales charge. So instead of paying their sales charge going in or coming out, they pay a sales charge every year for as long as they hold it. It's typically like 1% per year. So as long as they hold it. So paying 1% a year for like 10 years is not a good deal. But for 2 or 3 years, it might make sense. It might cost less than the upfront or the back end. Right now, Class C shares are better for short or uncertain time horizon. Okay, right? They have the highest operating cost, highest 12B1 fees, right? And they never convert to any other type. And by the way, I worked as a rep for 8.5 years. I never once took an order for Class C shares. So yeah, I expect most of your questions on the test to be about Class A shares, and especially about the NAV and the POP pricing. Okay, so this kind of a little sums up here about the Class A, B, C, and shares. So the Class A shares you buy at the public offering price because that's inclusive of the sales charge going in. Maximum again sales charge is 8.5%, and there can be ways of reducing that sales charge with breakpoints. A breakpoint's like a dollar level where the sales charge is reduced. Lowest operating cost, better, and like I said, is better for long-term investors and for people with more money to invest. Class B shares, better for someone who doesn't have as much money, should plan on holding at least long enough to avoid paying sales charges. Okay, and has a back end sales charge, so they charge you if you they charge you if you sell early. And Class C shares, again, no upfront sales charge. They pay their sales charge every year for as long as they hold. Okay, dollar amount, it doesn't matter for Class C shares, but it's best for someone with a short or uncertain time horizon. Okay. Now, besides the 12B1 fees, which is one of the ongoing expenses of a fund, another of its expenses is the management fee. Now, the management fee that's for the investment advisor, right? The investment advisor who manages the whole portfolio, makes all the buy and sell decisions. And that's usually the largest single expense that a fund has. It's also an asset-based fee. So it's basically a percentage of the money that manages. So maybe the investment advisor gets, I don't know, 1.5% a year, or 1.75% a year, or whatever it is, okay, that they get that. Oh, and of course, if the manager, right, grows the fund by making good, smart investment decisions and attracting more investors into the fund, well, their fee is a percentage of that. Now, as Gnosis says, they're not allowed to charge based on performance. They can't get a fee based on if you do better or do worse. They can't get a piece of, they can't get a percentage of the profits. That is not allowed. Okay, I'm going to jump over to the one on the right here because actually, hang on a second. Let me see if there is mention here. I don't seem to see it. Okay, all right. So of the fees that a fund has, all right, there's the management fee. We already mentioned the 12B1 fee, which is for marketing and promotion, and then there's the administrative fee, and that's everything else. That is the cost for the custodian for taking care of everything, for the transfer agent for doing all the processing and paperwork, legal and accounting, and keeping the lights turned on. Right. So everything else falls under the administrative fee. So if you add up the management fee, 12B1 fee, and administrative fees, that's the total ongoing operating cost of the fund. Right. Take those total expenses, divide by the net assets of the fund. That is the expense ratio of the fund. Right. Okay. So it's average net assets. So when you're evaluating a mutual fund, of course, expenses are going to play a role, right? Income minus expenses equals profits. So we're going to look for, at least consider, funds that have lower expenses compared to others in its category. Okay, so that is it. It does mention that index funds have the lowest expense ratio, and that's what they're known for. Index funds have a much lower management fee. See, in a regular mutual fund, a managed fund, the fund manager is doing all the research and figuring out what to buy or sell. The more actively the manager is involved, the higher the management fees. In an index fund, the fund manager is just tracking something else. That's passive management. Let me write that down for you because it's going to be one of the key terms here. Passive. Try again. That's passive management. Okay. So they have lower expenses. Now, by the way, also exchange traded funds, they're also use an indexing strategy. So ETFs also they're famous for, that's their whole deal. That's their whole claim to fame. Okay. So here's an example of net income investment. So it says assume that a fund has $200 million of total net assets. Right? So net assets meaning, right, assets, subtract out the liabilities. Also assume the fund's income statement shows as follows. So gross income, right, $20 million of investment income. Now, what is investment income? Investment income is interest and dividends. So if the fund holds bonds, bonds pay interest. If they hold stocks, stocks pay dividends. So that is their gross investment income. Now we're going to subtract out fees and costs here. Management, distribution, custodian, all these things basically until we come down to their net investment income of $18 million. So this would have been $2 million in charges. So the question is, what is the fund's gross return on assets? Gross return, of course, is the $20 million that it collected in interest and dividends divided by the $200 million in net assets, or 10%. But what's the net return on assets? And that's going to be the more important number. Not just what do you make, but what do you get to keep? So their net return was $18 million out of the $200 million in net assets for a 9%, right, return on assets. All right, again, we're going to look at the same thing, but now the question is, what's the fund's expense ratio? So the expenses, right, so how much were the expenses? Well, if you add them all up, we knew they came up to $2 million out of the $200 million, right, in total assets. So this fund has a 1% expense ratio, which, by the way, is actually quite low for an actively managed mutual fund. Okay, good. The next section is on the mutual fund distribution and prohibited sales practices, so which includes things that, well, you're not supposed to do. Tell you what, though, before we move on to our next section, we're right about at the top of the hour. So this is not a bad time to take a break and return at 8 minutes past the hour. Okay, now, as always, if during our break, if you have a question or if you'd like me to go back to a previous slide, please just unmute and ask a question or type a message in, and I'll reply to you in text. 1 second here. Okay, question was, can Class B convert to Class A? And the answer is yes. After the contingent deferred sales charge has run down to 0, usually takes between 6 and 8 years. Yes, they convert over to Class A shares without paying a sales charge. Okay, hope that helps, and we'll see you in a few minutes. Okay, so let's continue. Okay, thank you, Amy. All right, so know that things are working properly. All right, so mutual fund distribution and prohibited sales practices, right? Things that you're not allowed to do. All right, here's the thing, okay? To be in compliance with the tax code, Mutual funds and other investment companies, this applies to closed-end funds, it applies to unit investment trusts and all that, they're required to distribute minimum 90% of their net investment income to shareholders and pay it out as a dividend. Now, if you remember that investment income is interest and dividends that they collect from their investments. Net investment income is interest and dividends after expenses. So they have to distribute minimum 90% of what's left and pay them out to shareholders. This becomes a regulated fund under the IRS code, which is called Subchapter M. Subchapter M is known as pipeline theory, or also called conduit theory. Basically, this is the idea, is that a mutual fund is just like a neutral pipeline, right? Just basically takes money from the investment source. It's like a money funnel. Takes money from the investment source, right? It's the investments in a portfolio, deducts expenses, and then passes along what is ever left to shareholders and pay it out as a dividend. The fund itself is just passing money along as a neutral pipeline or conduit. Investors will pay taxes on their share, each one's share, of the dividends that each investor receives, and the mutual fund will pay taxes on the 10% that it retains. Okay, now what happens if they don't distribute 90% of it? Then it becomes an unregulated fund under Chapter M, and there are some tax consequences. If it was unregulated, even if they distribute just 89%, the fund must pay taxes on 100% of the dividends, the net investment income, all of it, right? What they distributed and what they didn't. Right. Investors will pay taxes on their share of the 89% that they receive too. So if they're not in compliance with the tax code and distribute at least 90%, there's going to be some double taxation going on. So as you can see, I think there's a really big incentive to be a regulated investment company under Subchapter M. Okay. Okay. I remember Subchapter M as being pipeline theory because I play a lot of video games. So whenever I see this, I think of the letter M, Subchapter M, I think of Mario and Super Mario Brothers. So I just remember Mario running through the pipes, holding bags of money, and jumping over crabs and jumping into mushrooms, okay, to deliver bags of money to shareholders. So that's just how I remember it. Subchapter M, Mario, running through pipes, pipeline theory. Okay. For mutual funds, the ex-dividend date, remember X means without, the prefix EX means without dividend. So that's the day that anyone who buys on the ex-dividend date or later does not receive the next dividend payment. Open-end funds, because of mutual funds, they do not have a 2 business day settlement. Stocks, if you recall, right, when trade with stocks with a 2 business day settlement, the ex-dividend date without dividend is 1 business day prior to the record date. Because if they buy it 1 day prior to the record date, they won't take delivery until 1 day after the record date, 1 day too late. Mutual funds, however, do not have a settlement period. They're a cash settlement. As long as you get your order in before the 4 p.m. cutoff time, you own it the day you bought it. And you're on the records the day you bought it. So for a mutual fund, the ex-dividend date is the day after the record date. Right, so it's the day after. So as a mutual fund, they can buy it on the record date itself. And as long as they get it before 4 p.m., they own the stocks. They own the shares and are entitled to the dividend payment.
And you said that's 4 p.m.? And
4
that's
p.m. Eastern time.
regardless if it's cash or not?
Right. Yes. Mutual funds, the cutoff for trading for that day is 4 p.m. Eastern time. People have to get their order in before the 4 p.m. cutoff time to receive shares of that day.
Okay, so there's different cutoff times and different payment methods. One of them is cash, right? If
Well,
you
there is a
receive
cash,
cash
yeah,
by
there is a
Tuesday.
cash settlement, but that's for something that normally would have a 2 business day settlement. Right? The investors can arrange a cash settlement that the trade will settle same day. And yeah, that's by 2:30 Eastern time. Mutual funds don't have a cash settlement, don't have a settlement period at all.
Okay. I'm just trying to keep it all straight.
I know it's a little tricky sometimes. Okay, 4 p.m. Eastern time, by the way, is a hard cutoff time, right? So you have to get your order before 4 p.m. To qualify for that day's pricing. If the order comes in at 4:01 Eastern time, too late for that day. Okay, it's a hard cutoff. In fact, firms that sometimes let people get their order in after the 4 p.m. cutoff time and still get that day's price, that's a violation called late trading. Okay, that's the SEC came down on firms that permitted. Yes, Jason.
Yeah, so it's like anytime before 4 p.m. or
Yes, yeah. Get
okay.
their order before 4 p.m. Eastern time for that day's price. At 4:01, too late for the same day. Then the order's good for the next day. All right. Okay. Now also there's the annual capital gain distribution. Remember, capital gains are trading profits. So if the fund manager buys an investment and sells it for a profit, the fund has a capital gain. Each investor in that fund, each shareholder will receive their share of those profits as a capital gain distribution. Your key word is distribution. Right there. The keyword is distribution. That's the one that tells you that it came from the mutual fund, from the fund's trading profits. So at the end of the year, and they can only do this once a year, so it's probably going to be in December. The fund will add up all its winning trades, then they add up all its losing trades, right? Subtract the losers from the winners. Whatever's left over is its net capital gains, and then each investor gets their share of those net capital gains and distribute as a capital gain distribution. And investors will pay taxes on their share of those distributions. Okay. All right. Now, by the way, it also says that net losses are not distributed. So what if the fund had losses instead of gains for the year? Does all the investors get a capital loss distribution that they can deduct from their income? I'm afraid not. No, there's no such thing as a capital loss distribution, only capital gains. All right. Now, here's talking about the investor's cost basis. Now, cost basis, remember, is the term for the amount of money that someone has put into an investment, which would be, of course, the amount of the investment. But if they had reinvested their dividends and just said, put it back into buying more shares of the fund, that's going to increase their cost basis. Now, when they sell their mutual fund, they're going to take with their sales proceeds, what they got from selling it, subtract out any commissions, and if what they sold it for is more than what they got out of is more than they put into it, then they have a capital gain. Notice I said capital gain. I didn't say capital gain distribution. Distribution specifically means it comes from the mutual fund for the fund's share of profits. When investors sell their own mutual fund shares, then the investor has hopefully a capital gain, but it could, of course, be a capital loss. All right, we mentioned a couple of times about a breakpoint sale. Now remember, yes, Karina.
Is the cost basis from the initial investment, or is it like a fixed amount?
Well, after you put a fixed amount into the fund, you said, okay, I want to buy $15,000 of the fund. Your cost basis is $15,000. Now, if you come back later and says, I want to invest another $5,000 into the fund, now your cost basis is up to $20,000. And if you got your distributions, but you said, hey, don't send me a check, instead just reinvest it back into the fund. Maybe you got $200 worth of distributions. Now your cost basis is $20,200.
That makes sense. Thank you.
Yeah, add them all together. You bet. Okay. All right. So a breakpoint sale. Now remember, a breakpoint is a dollar level where the sales charge is reduced, a volume discount. A breakpoint sale happens when the rep says, well, the rep does not tell a customer, says, hey, if you bring just a little bit more, you get a reduced sales charge. Regulators figure you're trying to hide that information because you're trying to charge them a higher percentage and pad your own paycheck at your customer's expense. So figure this way: if they're within 10% of one of those breakpoint thresholds, yes, you should tell them and let them know. Now, if your customer says, no, I just want to invest what I said, right? The breakpoint said $25,000 and they invest $24,900. You should say, yes, bring in $100 more. You get a reduced sales charge. Your customer says, nope, this is the amount I want. You've done your job. You've done exactly what you should do. Now, notice here it says should not spread money between different fund families. So if you have a fund, and so you say, you got this money to invest, let's put, you got $1 million to invest. Let's put your money between the Dreyfus Fund and the Vanguard Fund and the Federated Fund and the T. Rowe Price Fund and the Franklin Templeton Fund. Why is that wrong? Because you're spreading it out between fund families so as to reduce their ability to get a reduced sales charge, right? If you keep all your money at Fidelity or keep it all at T. Rowe Price or keep it all at Franklin Templeton, right, you'll get a reduced sales charge. Spreading it around like that is deliberately trying to keep someone from getting a break point. a reduced sales charge. That's a violation. Okay, churning mutual funds. Okay, churning again is basically it's excessive trading just to make commissions. That's what's known as churning. Okay, inappropriate recommending Class B shares. Okay, like I said here, first off, basically this. Class B shares, it's true, you don't pay a sales charge going in, but they make up for it as they go. They have higher operating costs. It's pay now or pay later is really it. Also, by the way, would you tell a mutual fund investor, would you tell someone says, if you buy these Class B shares, as long as you hold them for 7 years or whatever it is, it's just like a no-load fund. Would you say that to them? I sure hope you said no, because it's not a no-load fund. If they sell early, they're going to face a sales charge going out. Okay, here's a question that says, is cost basis stated from the initial investment? Oh, does it change? I think I hopefully addressed that. It is the initial investment, but it can change over time, especially if someone reinvests their distributions back into the fund. Question says, so the breakpoint sell keeps the investor from investing in multiple companies? Well, at least if you're recommending it to somebody, yes, you don't recommend multiple companies, because if they keep all their money with one fund family, they're going to get reduced sales charges. And by the way, you can get all the diversification you need from one fund family, right? Everything you have at T. Rowe Price, or everything you have at Fidelity or Vanguard, right? They've got enough mutual funds, right, to give you all the diversification you need. Okay. Yeah. All right, selling dividends. Now that's a practice of calling your customer and says, hey, the XYZ balance fund is about to pay a massive dividend. You need to get in on this right now, right? Buy it right now, just before the ex-dividend date. Why is that why is that a problem? Well, because they'll get that dividend, right? If they buy it before the ex-dividend date, right on the record date itself, they'll get that dividend payment. They'll get that cash paid to them. But remember what happens to the net asset value of a mutual fund on the ex-dividend date. Its net asset value is reduced by the exact amount of that dividend. Even if it paid 75 cents a share in dividends, the NAV is reduced by 75 cents. So bottom line, yeah, they'll get the cash payment on one hand, but their mutual fund is going to reduce by the exact same amount. So bottom line, there's no change. They have exact same bottom line, except for one thing. Taxes are due on dividends in the year that they are received. So encourage someone to buy a mutual fund right at the ex-dividend date. They get no benefit from it minus taxes. So that is definitely a violation. Okay, yes, Karina, the rule is for the advisor not to recommend multiple fund families, right? To recommend to their customers. They might consider that to be churning, right? You're trying to get extra commissions out. Okay, so that is our section here. Our next section here is about other packaged products. These are things that that don't fall necessarily so neatly under the Investment Company Act. So open-end funds, closed-end funds, unit investment trusts, or face amount certificates. So here's one of the things is exchange traded funds. I mentioned them briefly earlier. It wouldn't surprise me if you get a question or two about them because they become very popular. An exchange traded fund, it's like a mutual fund, right? It represents a ownership or a package in a big, huge portfolio of investments. Right? They put a lot of people's money together, raise millions of dollars, use it to create a big, huge portfolio full of investments, and everyone who's put their money in has a piece of this investment pool. The thing is, though, mutual funds, right, only buy and sell once a day at the end of the day at that day's calculated net asset value, whatever it comes out to be. Exchange traded funds, however, like the name suggests, are listed and traded on a stock exchange, and they trade like stocks. Since they trade like a stock, that means the price fluctuates up and down throughout the day. Right? The price at that moment is basically based on supply and demand at that particular moment. What are people willing to buy or sell for? So you don't have to wait till 4 p.m. to sell, and because they trade like stocks, you can place limit orders on them, you can place stop orders on them, you can buy them on margin or sell them short, you can day trade them. Those are things you can't do with mutual funds. Okay, so they're known for having much more flexibility. That's why they have more versatility to them, and that's what made them popular. Right? Also, exchange traded funds are managed as index funds. They use an indexing strategy. So all they do is track and mirror a stock market index. Let me just look real quick and see if there's mention here. Okay, there's mention here, so I'll come to that here. Okay, now now even though they look and act a lot more like closed-end funds, they're actually categorized as open-end funds. Now the reason is because this is like behind-the-scenes stuff. You see, a closed-end fund, it also trades like a stock, and its price is based on supply and demand, which means if the demand is very high, the price can get pushed up above, right? Its intrinsic or net worth value, its own net asset value. And if the demand is very low, the price could drop down below its net asset value. Exchange traded funds, however, have mechanisms in place to maintain the actual market value as close as possible to its actual net asset value. So it becomes a much truer representation of the package of investments that it follows. So the financial firms that sponsor them actually profit if the market price strays too far away from its actual net asset value, from its net worth value. We don't have to worry about how they do it. I've never figured out how they do it, just that they do it. Okay, so that's why even though they look and act like open-end funds, I'd say look and act like closed-end funds, they're categorized as open-end funds because under certain conditions, the sponsor of that fund, the ways that create them, they can create new shares under certain conditions or cancel existing shares. So that ability to create new and cancel existing makes it categorized as an open-end fund, even though they look and act like closed-end funds. Okay. They are not redeemable by retail investors. Retail investors have to trade them like a stock. Large investors, right, and the firms that sponsor them, they call something called creation units. Again, don't worry about what they are exactly. They're not going to get that detailed into the test. Just recognize them as part of the structure of an exchange-traded fund that can be redeemed for the actual stock itself rather than traded for cash. Okay, now the exchange traded fund, they're done as a indexing strategy, like I mentioned. So, in fact, the granddaddy of the exchange traded fund, it was issued about 25 years ago, I think, was called the Standard & Poor's Depository Receipt, SPDR, Standard & Poor's Depository Receipt. Well, with a name like that, it didn't take long before it came up with a nickname called the Spider. All right. So that was the very first one, and its whole investment objective was to match and mirror the S&P 500 by buying the same 500 stocks that Standard & Poor's created its index. So this was also passive management, which keeps the management costs very low. And they're also considered more tax efficient because they do very little trading. There'll be very little in the way of capital gain distributions because they don't trade a whole lot. So the thing of exchange traded funds, their deal is very low costs and fees. And again, low expenses lead to higher profits. Okay. Oh, there is people are assuming there's a slight lag. Oh. Okay. Yes, you did lose. I did lose connection. My Wi-Fi decided that was the exact moment that it needed to drop. So, okay, thank you for your thumbs up and your and all your party horns. Okay. All right. Thank you very much. Okay, so I think we're back, and apparently people experienced some lag, which was our warning sign that I was losing my Wi-Fi connection. Okay. Okay. So again, with the exchange traded funds. Okay. Uh, since they've been issued, they've become very popular. So there are a lot of exchange traded funds now. Why? Because of low fees and expenses plus the flexibility of trading them like stocks. So since they were issued, they've come out with some variations on the theme. One of those variations is a leveraged ETF. They use these techniques, they use like using derivative securities to increase the rate of return from the index that it tracks. So they use these leveraging techniques to increase the rate of return. And what we have they offer funds that deliver, let's see, I'm trying to get this on screen here, that deliver 2 times, 3 times, and I've even seen 4 times the return of the underlying index. So like it says here, right? If the market goes up 10%, A leveraged ETF would go up 20%. But at the same time, if the market is down 10%, a leveraged ETF would go down 20%. So you see there's a lot more volatility here, much more up and down price swings, which increases the level of risk, right? Volatility, up and down price swings, that's the source of the risk. Also, it costs them more money, right? There's higher expenses involved in doing these leveraging techniques. So they have higher expense ratios than a standard exchange traded fund. So therefore, a leverage ETF is better suited more like for a short-term trading vehicle rather than so much a buy and hold investing vehicle. Yes, Jason.
So when these leveraged ETFs are up, is that when you might want to try selling them?
Well, possibly, or okay. Well, the idea is that okay, a bullish investor buys an exchange traded fund because they think the market's going to go up, but a super bullish investor, okay, would buy a leverage ETF because if they were right and the market went up, their investment's going to go up a whole lot more. On the other hand, if they called it wrong, then the market goes down instead of up, it's going to go down a whole lot more. So the idea is that more like bigger level of risk. Right.
So the whole point of this is when it's up is to sell out or cash out or
Well, that's up to each investor. It's just that if they're ready to think it's going to go, if they think it's going to go up big, if they're really bullish, they'd buy a leverage ETF, right? Because they're expecting a big move and they really want to capitalize it. But of course, they're going to have a higher level of risk as a result.
So, in order to cash out on it, they have to sell the bond.
Well, eventually, eventually, yes. You got to take your profit sometime. Okay, all right. So yes, they would sell it eventually.
Time limit?
No, not at all. Not at all. Remember, they trade like any other stock.
5 months ago, they could cash out on it. 2 months ago, 3 months.
Anytime. Remember, like I said, they trade like stocks. You can day trade them. You can buy it in the morning and sell in the afternoon. Okay, right. Or you can hold them, or you can buy and hold for years. Okay. By the way, I've got an exchange traded fund myself. I've got an exchange traded fund that's based on the NASDAQ 100. NASDAQ 100, which is the 100 largest non-financial firms traded on NASDAQ. Its ticker symbol is QQQ, so it got the name the Cubes. Okay, so that's its nickname, the Cubes. Probably another one that may come up with is the one based on the Dow Jones Industrial Average, right? The same 30 stocks that make up the Dow Jones Industrial Average. So its ticker symbol is DIA, and it became known as the Diamonds. I don't know how likely that is to show up on the test, but I have seen it in textbooks, so I figure I'd better bring it up. All right, another variation on the exchange-traded fund is the inverse ETF. Inverse means opposite. So this fund goes in the opposite direction of the market that it tracks. In this case, if the market's up, say, if the market's down 5%, an inverse ETF would be up 5%. Right, it goes in the opposite direction. So this might be for the bearish investor. If they're expecting a market downturn, they might purchase an inverse ETF. And the super bearish investor, the one who thinks the market is going to crash, they might buy an inverse leveraged ETF, which means if the market's down 5%, an inverse leveraged ETF would be up 10%. But keep in mind, right, double the risk also. If the market goes up 5%, an inverse ETF goes down 5%, an inverse leverage ETF goes down 10%. Okay. FINRA and the SEC, like it mentions here, leverage and inverse are designed basically, or at least should be considered for short-term trading rather than buy and hold investing. Okay, so that's the concept. That's one thing that FINRA and the SEC want to kind of get across. Okay. Exchange-traded notes is another type of exchange-traded product, but exchange-traded funds are equity. Equity means ownership, right? They own all the stocks in the basket of portfolios. An exchange-traded note, however, is a debt security. It is a bond. So, which means that, right? So it's a loan. It's a debt security that's issued by a financial firm like a bank. But instead of being exchange traded, though it is a bond, but it lists and traded on a stock exchange, and it trades like a stock, even though it's a bond. More than that, it's a bond. It's a debenture. So it is an unsecured bond. There's no collateral that's been pledged, right, to back up that loan in case of default. So they're only backed by the issuer, right? They say by their faith and credit of the issuer, their good name and their promise to pay. Okay, so this is an unsecured bond, right, which is also known as a debenture. Okay. Now, here's the thing with the exchange-traded notes. They are bonds, they are debt securities, but first off, they're like zero coupon bonds. They don't make regular interest payments. They only come pay when the note comes due on the maturity date. The return, rather than being a fixed locked-in rate of return, the way most bonds are, all right, in a zero coupon bond, it's basically give them this much now, get that much back later. You know exactly how much you're supposed to get. But an exchange-traded note, you don't know how much you're going to get because the rate of return is going to be tied to something like a stock market index or some basket of investments, such as the S&P 500. So if during that period of time, if the S&P 500 outperforms, then investors in this who bought this exchange-traded note are going to get a higher rate of return. They're promising them the return of the underlying market index minus expenses. However, if the S&P 500 underperforms at this time, well, investors are going to get a lower rate of return. They get a lower interest payment. So therefore, they're actually kind of basically based on the stock market, which is why they can trade, buy, and sell like stocks. Okay, and again, since they trade like stocks, you can buy them and sell them at any time, place market orders, limit orders, and stop orders on them, and even day trade them if you want to. All right, so here's kind of the summary: exchange traded note funds versus exchange traded notes. As I said, even though they look and act like closed-end funds, they're structured or categorized as open-end funds, whereas exchange-traded notes are bonds, they're debt securities. ETFs do not have a maturity date. They can potentially last forever. Exchange-traded notes do mature just like bonds do. Both of them, however, trade like stocks in the secondary market. And in both cases, their market return is based on a market index. In the exchange-traded fund, you own a piece of this investment pool. You own shares of the ETF. You own a piece of this big, huge investment portfolio. With an exchange-traded note being a bond, it's a loan that is issued to the corporation, to a financial firm like a bank, backed by their faith and credit. They're both considered tax efficient, right? Because the interest on an ETN, since it's based on a market index, it's traded like a capital gain, not like ordinary income, not like interest on corporate bonds. So it is taxed at a lower rate. Exchange-traded funds, they do very little trading. Remember, every time a mutual fund buys and sells something, it's going to record a capital gain or a capital loss. Now, hopefully a gain, of course, but at the end of the year, they've got to distribute their gains to investors. Now, some investors don't like receiving these capital gain or dividend distributions because it's taxable income to them. They don't want to pay taxes until they have to sell the thing, and then they'll pay a long-term capital gain after that, but would rather not to have to pay taxes sometimes along the way. So that can be an attraction for certain investors. Okay. Real estate investment trust, REITs. That's how you pronounce it, by the way, REIT. They are not considered investment companies under the definition of the Investment Company Act of 1940. And that's because to be considered an investment company, they take all this money that they raise from investors, they would put it into buy securities with it. Real estate investment trusts don't buy securities, they buy real estate. So they are not defined as investment companies based on that, but nevertheless, they look and act like closed-end funds. Right? They issue a certain number of shares, right? They do a one-time initial public offering, raise the capital they need, and to invest with, to purchase real estate with, and then the shares are listed and traded on a stock exchange, bought and sold like any other stock. Okay. So what does a real estate investment trust do for an investor? Well, basically, it allows them to diversify their investments into commercial real estate without actually having to own or purchase commercial and manage commercial real estate. Okay, so because they're organized as a trust, right? They issue shares of beneficial interest rather than common shares. You notice that's the exact same words that unit investment trusts also called, right? Investors who buy UITs also purchase SBI, shares of beneficial interest. Okay, but nevertheless, They trade like stocks. They look and act like stocks. So investors aren't really worried what they're called. They're worried that they make money on them. Now, also, even though they're not defined as mutual funds or investment companies, they're still subject to the same tax rule that mutual funds have, right? And they are regulated under Subchapter M. They are required to distribute minimum 90% of their net income, that's after expenses, and pay it out as a dividend to investors to be in compliance with the tax code. And the dividends are typically taxed as ordinary income. Okay, so what does it do? So basically, when someone buys a real estate investment trust, they buy into a portfolio of real estate. To qualify under this Subchapter M, right, under this the tax code, where they only have to pay taxes on the 10% that they retain, a minimum 75% of the income has to come from real estate. Now, some of them, let me just check and see if they mention it. Hang on a second. Okay, some of them are equity REITs. Let me write this out for you here. Right. Equity REITs. Right. That means, right, equity means ownership. They buy the property. They buy the office buildings, or data centers, or medical buildings, or well, what type of real estate it is. Okay, strip malls, right? They own the real estate and they lease the space out to renters, to companies, and that's how they make a living. It's basically a property management company. But some of them, however, right, are called mortgage REITs. They don't buy the property, they buy the mortgage on the property. They buy the mortgage from the bank. That way, when the property owner makes a mortgage payment, the interest and principal payments go to the REIT. The REIT then, after deducting expenses, right, distributes to investors. Okay, and some of them are hybrid REITs, which means that they do both, right? They own real estate and they purchase mortgages as well. Okay, so minimum 75% of their income has to come from real estate. 75% of its assets have to be in real estate or government bonds or cash. Okay. All right, so that's what we need to know about real estate investment trusts. Most of them are public REITs, which means they bought and sold and traded publicly on a stock exchange. But there are private REITs. They're organized as private placements, like under Regulation D, which make them exempt from registration with the SEC and typically just offered to accredited investors. Remember, those are people who meet certain financial conditions. Right? And institutional investors, that means financial institutions, also meet the definition of an accredited investor. Some of them are registered with the SEC, but instead they don't trade or listed on the stock exchange. Right? They might be over the counter, which makes them a little less liquid. Right? Makes them harder to buy or sell sometimes. Most common, of course, are listed REITs that are listed and traded on a stock exchange. And because they're on a stock exchange, that makes them highly liquid, which means they're very easy to buy or sell. Just pick up the phone or click a mouse, and you can buy or sell them easily. All right, hedge funds. You might have heard them as well. Hedge funds are they're called private funds because they're not offered and they're not available to the general public. They're also done as a private placement, exempt from registration with the SEC. And they're usually structured as limited partnerships. So in a limited partnership, right, there is a general partner, that would be the fund manager, who's going to manage the fund and do all the work, okay? And then there are the limited partners, the investors are limited partners, who are the silent partners. They're the money partners. So they're basically just investors put their money in. Since they're done as private placements under Regulation D, typically sold only to accredited investors. But because of this, they're also highly illiquid. Right? There is no trading on, there's no secondary market for them. If you're in a hedge fund, you have to be expected to be in it for the duration until they ultimately dissolve the fund. Right? So if you ever might need cash or have an investor, one of your customers who might need to come up with that cash, a hedge fund is not the place to put them in because they're going to have a very hard time cashing out. As a limited partnership, all right, limited partners can only sell their shares with permission from the general partner. And even if they got permission, who are they going to sell it to? There are no limited partnership exchanges. So it's going to be extremely difficult to sell, even if you get to sell them. All right, because they're sorted as private placements, though, gains and losses pass directly to each limited partner. So the gains that these investments make, subtract out the losses, and each one gets their share of them. Okay, now the word hedge means protection, right? It means to protect them. Nevertheless, for the test, we will consider hedge funds to be high-risk investments for sophisticated investors. Now, they call them hedge funds because they're not considered investment companies. They're not mutual funds. And so they're not subject to the restrictions that mutual funds have. Mutual funds are not allowed to trade on margin, right? That's borrowing money to leverage investments. They're not allowed to sell short. That's borrowing securities. They're not allowed to speculate with currency or commodity futures or options. But hedge funds can do all those things. They get the name because they're supposed to be able to make money in any kind of market, up markets, down markets, or sideways markets. Okay. So, but nevertheless, we consider them aggressive investors for sophisticated investors. They typically have high minimums. Let me see if there's any mention here. Yeah, typically high minimums, like $1 million easy to get into one. And you have to qualify, like I mentioned, you have to qualify with the general partner to be a limited partner. And they also tend to be expensive. They have high fees and expenses. A typical structure, they call it 2 and 20. 2 and 20. That means they charge a 2% annual management fee. All right, that in itself is actually fairly high, not unreasonable, but fairly high. But also 20% of the profits go to the hedge fund manager, the general partner. Mutual funds are not allowed to charge a percentage of profits, but these aren't mutual funds. So, so they tend to be. So why do people get interested in them? Well, when they do well, they do extremely well. I mean, like 20%, 30% returns, not entirely unheard of for hedge funds. Okay, so that's the thing of hedge funds. Now, since most of us can't get into a hedge fund, like I said, you probably have to deposit $1 million easy, be categorized as meet the definition of a accredited investor. It's a rather small percentage of the population, but any of us could buy a mutual fund. So what if we buy a mutual fund that itself buys hedge funds, a fund of hedge funds? So what do you got with a fund of hedge funds? Well, you have a mutual fund that anybody can get into. They usually have higher minimums, though, like $25,000. That's quite a high minimum for a mutual fund. But what it does, you have a professional money manager who's buying all these hedge funds and evaluating these hedge funds and keeping track of what they do. So as to, again, kind of minimize any overlap, right? Make sure you diversify and spread it around. All right, but keep in mind now, we already said that the hedge funds already have high expenses and management fees, plus a fund of hedge funds. Well, that's another layer of management. So there's another layer of management fees. But it does offer a way for regular folks to be able to invest in hedge funds, kind of an indirect way. All right, direct participation programs, or DPPs. All right, now many of us haven't heard of these because it doesn't come up a lot for most people. In fact, before I even took this test, I didn't even know these existed. But it is, again, a limited partnership. So the structure, again, there is one or more general partners who manage the business, run the business, and they have all the role of management and operations. They also, by the way, the general partners have liability, which means they're vulnerable. They can be sued. If somebody sues the partnership, they sue the general partner. The limited partners, the silent partners, have no role in operations or management. They're basically investors along for the ride and have no role in management. In fact, if they ever take on a role in management or operations, they might lose their status as a limited partner. Limited partners have limited liability. If somebody sues the partnership, they do not sue the limited partners. The most they can lose is the amount of their investments. No one's going to come in and take their furniture. Okay. Now, because it's structured as a partnership, as a limited partnership, partnerships do not pay taxes. C corporations pay taxes, partnerships don't. Instead, it's the partners who pay taxes. So they're known as a flow-through entity, which means that this partnership, as it does business, will have some income, will have some profits on it, right? And each investor, each of the limited partners get their share of the profits that it makes. But each partner also gets shares of the business deductions, ordinary and necessary business expenses. And that includes things like depreciation on property, right? Or it can include depletion of natural resources, right? So they get income on one side, but also get deductions on the other side. Now, also again, because as a limited partner, you have to apply to be a limited partner with the general partner. You cannot sell your shares, your interest, without permission from the general partner. And even if you got permission, there's nobody around to sell it to. There's no DPP exchange. Maybe you have to put an ad on Craigslist or something. Otherwise, right, basically line up someone who wants to buy if you want to sell. So again, if you're in a direct participation program, you have to be expected to be in it for the duration until the partnership is ultimately dissolved. Okay. Now here's the thing, right? They have these considered losses. So when you're in a general partner as a limited partnership, since you don't have any active role of management in it, the income you receive that is called passive income. See, we in our tax code, we put our income into 3 buckets. Okay. We have earned income, right? That's what you get for doing a job, right? For running a business. Okay. We have investment income, and that's interest, dividends, and capital gains. And then there is passive income. Okay. So the thing is that any type of income you have can only be offset by a deduction, that same type of deduction. Earned income is offset by earned income deductions. Investment income, like interest and dividends, is offset by investment deductions, such as capital losses, right? Or it could be things like you have a safety deposit box to keep your stock certificates. Well, that's deductible against your investment income. And passive income from direct participation programs or from rental income, only passive income losses can offset passive income gains. Passive income losses cannot offset your ordinary or your earned income. So you kind of have to keep them in buckets. Okay. This was this happened in the Tax Reform Act of 1986. So prior to that, your passive income losses could offset earned income. Not anymore. So our phrase that we're going to remember here, to help us remember this, is that pals offset pigs. Passive activity losses. It helps if I can spell. Passive activity losses offset passive income generators. So if someone has a limited partnership share, a DPP, and they have losses in that, they can only deduct those losses against other passive income gains from other DPPs where they show gains. They cannot deduct it from their earned income. We'll see that. I'm sure we'll see this later. But if you have capital losses, which comes across from your investment income bucket, only $3,000 a year can be offset against earned income. Okay, we'll have a chance to see that. Okay, but this one, pals offset pigs, is your little phrase that pays to help you remember how they offset each other. Okay, what type of DPPs exist? What type of programs? I suppose anything could be, right? It could be, there's even a pizza place. Could be a direct participation program. But for the test, there are 3 kinds. One is oil and gas. All right, so basically, get a bunch of people's money together, right? A bunch of limited partners, put their money together to go drill holes in the ground. Okay, and drill for oil and natural gas. Now, even then, there are different types. Exploratory or wildcatting means that, well, okay, well, it's like Star Trek. To boldly drill where no person has drilled before. Okay, so it basically means we think there's oil under the ground, right? The geological surveys say there probably is, but until they actually set up some oil wells and start drilling, they're not going to know for sure. So these are considered to be very high risk, but hey, if it hits big. Developmental or step-out wells, those are ones that are built near existing proven resources, near an existing oil field. So there's a fair chance that they'll be able to find additional oil or natural gas near existing oil fields. And then there's the income wells or stripper wells. Those means that they're already proven, they're already found oil, they're already filling up oil barrels and selling them off and collecting income. So that produces a lower risk activity, but of course, no lower risk, but the lower potential return as well. But for people who prefer a lower risk, that is definitely a possibility. All right, besides the oil and gas, we also have, oops, it's not here. Okay, in that case, I'm going to have to tell you some more about them. We also have real estate limited partnerships, right? Or RELPs. Okay, so a real estate limited partnerships, they're putting all this money together from passive investors, right, from the limited partners, and they're going to use it to buy real estate, okay, and manage a property. Now, of course, even there are different types of managing properties. There can be a raw land DPP, which means they just buy a big lump of dirt. with nothing built up on that dirt. And therefore, there's nothing built on that. There's no structure on it that they can rent out and collect rental income from it. So why do they buy raw land? For the capital appreciation, right? That hope that they'll build a freeway pretty close by that lump of dirt, and that lump of dirt will become worth a lot more, and they'll be able to sell it for a profit. But they also have existing housing DPPs. So that means they've already bought a building or a series of houses or apartment complex or office buildings that already exist and already have tenants in it. So these are going to have a lower risk to them because they're already got paying tenants into them. Okay. There can also be a new construction. Okay, which means that they're going to build a building from the ground up. Okay, now this takes a while, right? It takes a while to build a building. It takes a lot of money to build a building. And in the meanwhile, there's no one in that building that they're going to rent some space to. So they're going to burn some cash for a while here before they start collecting some rental income. But nevertheless, it could have eventually some more potential. Another one they do, though, is low-income housing and historic rehab. Historic building rehab. Okay. What's so good about those is that, well, first off, there's always demand for low-income housing. Okay, but also is that many communities will offer tax credits, right? And a tax credit is better than a tax deduction. See, when you have a tax deduction, all you can deduct is your percentage, right? Your tax bracket percentage. If you're in the 28% tax bracket, you deduct 28%. But a tax credit is a dollar for dollar reduction in taxes. So there are some massive tax benefits for investing in low housing or historic building rehab DPPs. There is another one they don't talk about, mentioned a whole lot, doesn't come up a lot, but there is another one, which is equipment leasing. An equipment leasing DPP, which means that they basically buy equipment and they lease them to other companies. Airlines might not own their airplanes. They lease the airplanes. Railroads might lease their rail cars. A construction company might lease its earth moving equipment, doesn't actually own it itself. I knew somebody here locally in Phoenix, right, had a carpet cleaning business. He did not own the carpet cleaning equipment. He leased it, okay? And he paid basically to rent it. And so whenever it broke, right, he takes it back in and says, get me a new one. So he didn't own the equipment itself, right? He leased the equipment. So they buy the equipment, right, and they lease it to other companies and get income from the leasing agreement. Now, their biggest risk here, of course, is things like obsolescence, especially things like computer equipment, right? They go obsolete within like a couple of years. Okay. All right, so these are the ones that may come up, you may see mentioned on the test. Real estate, limited partnerships, equipment leasing, and oil and gas. And remember that a RELP is not a REIT. Remember, a RELP looks much more like a mutual fund or a closed-end fund. They distribute their net profits. But if a REIT has losses and not profits, they don't distribute losses. There is no deductible loss they send to anybody. But REITs, if they have losses, each investor in the REIT can have those losses distribute them, which to a certain extent are tax deductible, just against their passive income generators. Oops, let me just make sure there wasn't a message here. Okay. Oh, I'm sorry, Karina. I'm afraid I don't understand the question.
What did you say? A wealth or?
Oh, okay. No, I said a RELP.
Oh.
Real estate limited partnership. Okay, let me write this out for you here. Okay. Oops. A real estate limited partnership is not a real estate investment trust. Okay. Okay, and that is that part here. So private equity funds. Okay, so a private equity fund is a pool of assets to buy existing interest in existing companies, and they sell the companies after increasing their value. Again, because they're private equity, not offered to the public, get an exemption from registration under Regulation D, right, for private placements, and sold limited to accredited investors, highly illiquid investments. Remember, sometimes it's easier to get into an investment than it is to get out of one, right? That's an illiquid investment. Keep that in mind before you recommend things like DPPs, private equity funds, right? Or private REITs, okay? Because right, they may not be able to sell it so terribly easily, not without taking a massive hit sometimes. So it's got to be someone who can, who may not need that cash. All right. Well, with that, before we that kind of closes out that chapter. So before we go on, first off, anyone else have anything else that you need to know more about, collect down information about? Are we all good here? All right, then let's go ahead and take a very well-deserved break and return at 10 past the hour. Again, whatever that hour is, and if you need to go back to a previous slide, anything you want to know about, please feel free to unmute or type a question into the chat, and I'll reply to you appropriately. Okay. All right, here's our section. Here it is, our section on trading markets. Okay, so on how markets operate right now. So this would be about, question is, can I go over T bills versus T notes? All right. Okay, so first off, Treasury bills, T bills, they mature in less than 1 year, anywhere from 4 weeks to 52 weeks, but always under a year. Okay. Treasury bills are zero coupon bonds, which means they're purchased at a discount and mature at their face value of $1,000 when they come due. Treasury notes are medium term. That's anywhere from 2 to 10 years, from the time they're issued to the time they mature. Okay. And Treasury bonds are long term. Those are 10 to 30 years. Okay. Treasury notes and bonds, right, are bought or buy at par value, and pay semi-annual interest, the way most bonds do, right? Tear off your coupon every 6 months. Okay. All right. So the shorter the term of the bond, of course, right, the lower the interest that it pays, but also they're more stable, right? More stable in value. So they don't go up and down as much the closer they come to the closer to maturity. Okay. All right. It's helpful? All right. Okay. Thanks, Karina. All right. So let's talk here about trading markets. Okay. So first off, we'll talk about the types of markets and how we trade in between investors. All right. So first off, we've got these different markets. Okay. First off, we're going to divide them first into primary market and secondary market. So the primary market refers to the trading or the issue of sale of newly created securities, new issues being sold for the first time from the issuer to ground floor investor. All right, so it's like brand new securities, brand new issues. And who gets the money from the sale in a primary market trade? Well, the money goes to the issuer, right? The corporation, or it can be a government entity, and that's how they raise the funds and capital that they need to build, grow, or expand their business, or whatever it is they need financing for. So that's primary market, new issued securities sold to ground floor initial investors. Now, once they're sold to initial investors, then they can be traded between investors. So trading is secondary market. I think of it like secondhand securities. Somebody's already owned them at least once. So that's securities that have been already issued, sold first in the primary market with from the issuer to investor, and that's how they raise their money. And then there can be traded in between investors. So who gets the money from the sale in a secondary market transaction? Well, that goes to another investor, right? So at least somebody other than the issuer. Sort of like secondhand cars, right? If you sell, right, when you buy a brand new car, who gets the money? Well, the car dealership, of course, gives it to, right? Because they bought it. Well, they got it from the car manufacturer. But in a secondary market trade, secondhand cars, who gets the money from the sale? Well, whoever owned the car, right, sold it to somebody else. All right. Now, under the umbrella of the secondary market, there are 4 distinct market centers, places where securities are traded. They are, imaginatively enough, called first market, second market, third market, and fourth market. All right, here's one thing to watch out for. Remember, they try to trick you with vocabulary sometimes. Okay, first market is not primary market. First market is part of the secondary market for trading between investors. It's just considered the first place that they do it. The second market is part of the secondary market, not the secondary market itself, just part of it. Okay, so watch out for vocabulary. So first off, first market. This refers to the trading of exchange-listed securities on a stock exchange. Now, for the most part, when the test talks about a stock exchange, it's referring to the New York Stock Exchange. It is the biggest of the stock exchanges by far. So in our test, we're going to use this as our model stock exchange. There are other stock exchanges other than New York, right? There's the Chicago and Philadelphia and Boston exchanges and the American Stock Exchange, but we're going to talk about the New York Stock Exchange. The second market, this refers to the trading of unlisted securities, right? That don't trade on a stock exchange. They don't meet the qualifications to have their shares on a stock exchange. So they're unlisted securities that are traded in the over-the-counter market, OTC. Over the counter. Now that is a dealer market. Okay, that is a virtual, almost like a virtual market, in which there are competing dealers in securities that trade, buy and sell these securities, that buy and sell these stocks or securities, and that's where we have liquidity from them, so that we can find a place to trade. See, in a stock exchange, okay, is on a physical exchange floor, right? There's a building at the corner of Wall Street and Broad Street in Manhattan. And by the way, if you ever go there, there's a visitors gallery. You can take a tour, okay, right? Okay. All right. So there's a place that it goes to. The thing about an exchange, right? It is centralized. Okay. There's a single location where people go to find each other. Buyers and sellers go to meet each other there in this centralized location. It is also considered to be an auction market. Okay, because that's what the New York Stock Exchange is. It's an auction house. Securities are being auctioned off all day, every day, with people come in saying, I'm willing to buy at this price, and someone else, I'm willing to say at that price. So that's considered an auction market. The second market, however, the over-the-counter market, is not centralized. It is decentralized. There is no single location. So trading takes place in basically among dealers in securities who are called market makers. Okay, so decentralized, they're called market makers, who are dealers in securities. And as dealers, they say, I'll buy it at this price and I'll sell it to that price, but they compete with other dealers for the order flow. Okay, so it's decentralized, and it's called a negotiated market. Negotiated market. Okay, because you negotiate with other dealers, with all these competing dealers and shop around the best price, is basically how it works. The best analogy I could ever come up with to describe the over-the-counter market is to say, if you want to buy a car, you want to buy a Chevy, you can call up every Chevy dealer in town, so he'll give you the best price. You want to sell your car, you can go up every car dealer and see who'll give you the best price. Kind of like that, except they're not car dealers, they're securities dealers. And they all deal in these securities, and there's a bunch of them who might deal in this security, and you are shopping around the best price. Now, a lot of it's done electronically now, so you don't have to actually make phone calls or anything, but before it was, right, they actually had to make phone calls. A question says, what are listed versus unlisted stocks? Listed means that it is available to trade and can be traded and meets the criteria to be traded on a stock exchange. So we might say it's listed New York Stock Exchange. You can also say listed NASDAQ. Whereas an unlisted security does not get listed, is not able to trade on a stock exchange, probably because it doesn't meet the criteria to be there. So instead, they're unlisted and they trade in the over-the-counter market, which is a dealer market. All right, now NASDAQ, okay, NASDAQ is kind of a hybrid. NASDAQ was really second market, right, a dealer market, but it was the top tier of the dealer market, right, the high-grade securities that qualified to be for NASDAQ. Well, NASDAQ started taking on some characteristics. It was required by the SEC that made it look and act more like a stock exchange than it did as a dealer market. And so I think it was in 2007 that the NASDAQ petitioned the SEC to actually become a stock exchange. So even though it's not centralized, there's no single location, it's still among a bunch of competing dealers, but it's still now listed with the SEC and registered as a stock exchange. So NASDAQ kind of straddles both markets, but is considered first market. So we can say listed NASDAQ. Now, unlisted securities are second market, which goes under, there's a bunch of different basically parts of it or tiers under it. You might see the term pink market, or was originally called pink sheets. Okay, and it got the name pink sheets because, right, there was a company called National Quotation Bureau that would publish a list of over-the-counter securities on a daily basis with a list of who the market makers are and the last known price quote. And they delivered them on pink pieces of paper. So the phrase came. It was, hey, hand me the pink sheets. All right, they don't use pink pieces of paper anymore, but the name kind of sticks. What I would expect that you'll see on the test, they'll probably refer to it as over-the-counter. Let me write this out for you here, as over-the-counter or OTC non-NASDAQ. So it's the over-the-counter dealer market, but not on the NASDAQ, listed on the NASDAQ system or NASDAQ exchange. That's the phrase I expect to see it because it's kind of a catch-all term. All right, third market. Well, first market plus second market is third market. Third market refers to the trading of exchange-listed securities, but traded off the stock exchange, instead of traded in the over-the-counter dealer market among the competing market makers who are also competing with the traders on the floor of the stock exchange. So what does that do? It gives you more liquidity, more places to trade, more price competition. So that's the role of the third market. So it's a combination of first and second. All right, then there's something called fourth market. Fourth market refers to the trading of securities traded off the stock exchange in a direct system, basically a computerized system known as an electronic the slide says electronic trading networks, but ECN, I'm gonna correct it. Okay, I'm gonna call it electronic communication networks. And basically, it's like a closed computerized matchmaking service. And these are for trading in between institutional investors mostly. So that this allows the big institutions to trade among each other in gigantic volumes. Because let's say a company like BlackRock, right? So they got a gigantic financial firm, right? And they want to sell like 50 million shares of stock. Well, if they drop an order for 50 million shares on the stock exchange, that's going to crush the market. But they could put it into this electronic communication network. There are a few different ones, right? So basically each one is, is like its own closed network. There used to be more, but they've consolidated. But they can put an order in one of these electronic networks, like Instinet was the original one. And they say they want to sell 50 million shares, and they'll put the price they want to sell it for. Well, then a company like Fidelity, who's got the means to buy 50 million shares, well, they might put an order in one of these electronic networks and put in the price that they want to pay for it. Well, if they both put in the price, if they can agree on a price, the computer will match them up and execute a trade between them. That's what the fourth market is about. Okay, another is called ATSs, right, which is alternative trading systems. So by trading with each other like that in big volumes, it allows these 800-pound gorillas to wrestle with each other without trampling everybody else to death. Also lets them avoid the fees that the stock exchanges charge. Now, there's a thing called dark pools, or also called dark pools of liquidity, which allows these institutional traders to enter their orders anonymously. Maybe BlackRock doesn't want to show its poker hand to let the world know that they want to sell 50 million shares. Right? They might think, hey, BlackRock's looking desperate. They'll start adjusting their prices accordingly. So they can put an order anonymously. All right, now keep in mind, it's the order that's anonymous, not the transaction. Once a trade is executed, then it is reported, but allows BlackRock to place their trade without showing their poker hand. Okay. By the way, the fourth market is also a 24-hour market. So you might hear about after-hours trading. So they say, XYZ Corp announced earnings today, and in after-hours trading, the stock is up or down. Well, that after-hours trading is fourth market trading. Now, many firms they subscribe to one or more of these ECNs, and they allow their customers access into the ECN if they want to trade in after-hours trading, which, by the way, is a much thinner market than regular business hours, right? There's a lot less volume going on. The spreads between the buy and sell prices that tend to get wider in the active hours trading. Okay. All right. So broker dealers, a broker dealer firm is a stock brokerage firm like Merrill Lynch's and Smith Barney's and Charles Schwab's and Ameritrades and even Robinhood's. They're collectively known as broker dealers. That's their official name, called broker dealers, broker-dealer. Why does it get a hyphenated name? It's because it can act in one of two capacities in a transaction. It can act as a broker capacity, as an agent, right? As an agent, an agency basis means that they're acting on someone else's behalf. They're representing someone else in the trade. Or they can act as a dealer, And as a dealer, they act in a principal capacity. Principal capacity means they're actually part of the trade. They're on the other side of the deal. So as a stockbroker, as an agency capacity, think of a real estate agent. What does a real estate agent do? Find someone who wants to buy a house, match them up with someone who wants to sell a house, right? Facilitates a transaction between them and makes a commission, right? If a trade gets done, if a purchase gets done. Does a real estate agent have to buy the house? No, they don't buy the house. They show the house. So a real estate agent is never at risk of having to purchase, let's say, a property or real estate and then find out that they can't sell it again, at least not for what they paid for it. So it's a virtually risk-free transaction, okay, when acting as a broker or agency capacity. Now, what about a principal or as a dealer? Now, if you think of a dealer, think of a car dealer. If you go to a car dealership, you see rows of cars because they're working from inventory. As a dealer, they buy it at one price and sell it at a different price. So they charge a markup on what they buy, or markup on what they sell to you, and a markdown on what they buy from you. So they have inventory involved. Now, is there any risk in this transaction? There sure is. What if this dealer has purchased securities, holding it in its inventory, and then the security, it crashes? Now they can't sell it for near what they paid for it. So yes, there is a high degree of risk when acting as a dealer or a principal capacity. So if you place a trade, let's say you bought something, you bought an investment, who did you buy it from? If you bought it from some other investor somewhere out there in the world, your firm acted as an agent on your behalf, representing you in the deal in a broker capacity. But if your broker dealer sold it to you directly, right, at their trading desk from their own inventory, then they were a principal on the transaction. They were part of the trade, acting in a dealer capacity. How can you remember the difference? It's as easy as ABC. ABC, because an agent or a broker earns a commission. What about on the other side? What about the other type of transaction? That's easy too. Just think of Dr. Pepper. That's right, I'm a Pepper, you're a Pepper. Because a doctor is an MD and letter P for Pepper, which will remind you that a markup is charged by a dealer or a principal. Okay, and that's a little memory trick to help you remember those things. Okay, which puts together, this is our end of our this particular section here. So this is also a good time because we're at the quarter to the top of the hour, and it's the time I'm supposed to let you all out the door today. So anything else you'd like to review or ask about? If any part of this still needs a little clarity, a little something on this? Okay. Now, by the way, you probably noticed I am in the process of checking your grades in the Past Perfect system and moving them into Canvas. It's a manual process, so it takes a little while to do it. Okay. So I'm in the process of it, but you start probably seeing some scores lined up. By the way, if you have taken some, you've done the check your comprehensive things, for 5 points, and you've done, end of chapter exams, and you score that. If you've got a score maybe you're not all that thrilled with, by the way, take it again, right? See if you can outdo yourself. And when I go through them, I'll give you the higher score. Okay. I'm concerned that right. I want to make sure you get through this. The best way to get through this and pass the actual test is to take as many practice exams as you possibly can over and over and over again. So I'm going to suggest that you do so. So you can see if you can outdo your best. Yes, Jim.
Yeah, so I did notice that on my grades, like some of them are in there.
Yeah.
There's some of like maybe the quizzes,
Uh-huh.
the 5 question or 10 question quizzes.
Yeah.
That may not have been accounted for, but I know I have like 70%, some of them 80%.
Okay, I'm in the process of getting.
Oh, okay, cool.
It takes a while. Okay, I'm sorry. It's a manual process. I just got to.
Oh, is it?
Yeah,
darn.
I got to slug through and get through it.
Oh wow, you don't have an assistant, huh?
I'm afraid not. Okay.
Wow.
No, just little old me. Questions should be taken in the mastery test. Actually, that brings up. Thank you for the segue. In our next meeting on Wednesday, we're going to take mastery test 1. Now, I have noticed that some people took some initiative, okay, in taking mastery exams, and I'm no problem taking initiatives. But hey, take it again. And by the way, I contacted Past Perfect today just to make sure, because I was concerned. Well, if it's a mastery exam, does that mean you can only take it once? They assured me you can take your mastery exams as often as you like. So, and I don't think you'll see the same test over each and every time. It should draw out of like whatever bank of test questions that they have. Okay. So we're going to do the mastery exam 1 on our next meeting here. and but we'll also continue with our chapter 7, and I'll also have some more Cahoots for you too. Because all right, that I'm just making sure. Is this Cahoots thing working for you? I was some positive feedback before. Okay, so yes. The question is, does it mean you do it together? Well, you'll do it individually, okay, right? But we do it in class. Okay. All right, I'm getting a yes and a very helpful. Okay. Anybody who says the Cahoots, they could like take them or leave them. All right. Okay. Correct. Got to vote for keep. Okay. All right. You do like them. Okay. I'm glad to hear that. Okay. Actually, I think they are kind of fun. Susan. Okay. Oh, Kimberly. Virtual pause here. All right. It was Sue Sandblom actually who put those all together at SEC when she was head of the business college. Yeah, she did all the work on that. And that's no small amount of work to put that together. So okay. So our hats off to Sue for putting all that together. All right, folks. Again, please feel free to remember I am one of your resources. Email me something you need on that, something's not totally clear. And I'm still making an offer. Not I've had some people take me up on it, but it's still there. You and I, 15 minutes. We can talk about anything you want. Just one-on-one phone call. Okay. Take care, everyone. We'll see you again Wednesday evening. Have a great night. Thank you, Hannah. Okay. See you all later. Bye-bye.